I'll be now roping in Ravi Gopalakrishnan, the Chief Investment Officer, Equity, who has joined Sundaram Asset Management Company in January 2022 and has 3 decades of experience in research and asset management. Ravi's passion, if I talk about, ladies and gentlemen, very, very interesting, reading and exploring investment philosophies and methodologies of investment gurus like Julian Robertson and Peter Lynch, etc. He also enjoys playing sports like squash, taekwondo. His interests include traveling and, yes, I must mention this, listening to music, particularly Kishore Kumar and the Beatles. Should we ask him which one is his favorite number as well? All right, so as soon as I see him on the stage, all right. Ravi also supports a foundation dedicated to the families of the Indian Armed Forces and a couple of NGOs that work for the upliftment of the underprivileged in the rural Maharashtra. Ladies and gentlemen, please welcome very noble Ravi, everyone.
Thanks everyone. Such wonderful audience, and after 2 years, it's such a great pleasure to be on this platform. A lot of familiar faces, and I'm so happy that people are still smiling. Yeah. But to be honest, I've seen this markets over 3 decades, and there's like a lot of learnings in terms of how do you navigate this thing. The best thing is to ignore it. I know it's hard, but seriously, 3 bull markets, 3 very, very bad bear markets. I don't know if this is the 4th one. But certainly, a lot of these things are driven by events. And to be honest, I think events, will come and go. And, we need to be just focused. And as the earlier speaker said, it's all about discipline, and it's all about managing your, assets, allocation and everything, right? And, don't get really swayed by what's happening around you, because these things are completely out of control. See, a lot of times, this is a learning again, you think that you have control over everything, but most of the things you don't have control. So things that you don't have control, stop worrying about it. So I think, it is extremely important to get that concept clear in your mind, be disciplined about everything. Easy to say, but if you're not, it's not going to help you in any way, right? Keep worrying about things. Because these things are going to happen, not now, even the next decade is going to be very challenging, right? So let's move to the markets, and what do we think in terms of the medium term, right? So obviously, I'm not going to bore you with a lot of statistics and all. It's a very crisp kind of 5-slide presentation, but certainly I think even before this so-called war, right, the economy was facing a lot of headwinds, higher commodity prices, rising yields globally, also slowdown in demand. Of course, now the geopolitical situation and all of that. But one thing is very clear, that the macro recovery is going to be extremely broad-based. Now, we saw a huge polarized market about 2 years ago, and because the macros weren't doing anything. But today, things are changing significantly on the ground, and we are speaking to a lot of companies, and the general impression is that everyone is putting a lot of thought in terms of capacity expansion. Let's not forget, in the last 10 years, I call it not the last decade, but the lost decade, right? There wasn't any major investment that was happening anywhere in India. Now, looking at this budget, etc., you're obviously seeing a lot of intent. My sense is that, generally when you have such high ambitions, you may not achieve the whole thing. But I'm saying even if you do 50-60%, I think that's pretty good. And the sense I'm getting is, at least in the near term, because we have had so there's no rocket science, right, in all of this. Why markets were good last year and why markets may not be good this year. There's nothing really to think about. Typically, in a 10-year block, if you'll see 3 years of glorious returns. 3 years, markets won't do anything, and 3 years, markets will be down, and we'll be only remembering the 3 years that was down because we entered at the wrong time. right? So I think, the first half of the year is probably going to be sideways, maybe consolidate. But bouts of correction should be used to increase exposure to equities, because I think the next 5 years, there are a lot of building blocks, and I'll talk about a few of them, and as we move on. But in terms of sectors, I think financials probably are last year they didn't do anything, right? So from a valuation perspective, from a turnaround perspective, probably looking good. Also, the manufacturing and capex theme, because of which your auto, cement, engineering, these are, by the way, segments which didn't do particularly well last year. And of course, real estate. But let's move on to the latest quarter. I want to give you a sense in terms of how the quarter has panned out. Actually, not bad. If you look at a 2-year CAGR, I'm ignoring the pandemic portion, right? You look at the bottom part. You're seeing a decent top line growth. We're still not out of the woods, right? Demand is still not coming back. But there is a decent EBITDA growth of about 18 to 20%. And PAT growth of 30%. So maybe you might want to call it a little bit of a base effect or whatever. But certainly, look at that red number. EBITDA margins have contracted. That is because of high commodity prices, high input prices, which corporates haven't been able to pass on. And I think the situation is still pretty much similar. There's a lot of resistance to passing on prices. But look at this table on the right. Commodity prices have corrected broadly, right? Is it enough? Probably not. There is still some way to go. So if those prices starts to correct and the demand side starts to improve, then those numbers are going to look extremely good, right? So that's the reason I've put, focus of earnings is now shifting gradually to, the demand side rather than the cost side, right? I spoke about the capex cycle. Obviously this year's capex announcement in the budget has been unprecedented. There are a good chance that we may not meet all of that, but even if we do, like I said, 50-60%, that's a big number. PLI scheme could be a joker in the pack, because we are already attracting massive amounts of funds. I don't know how many of you picked up the semiconductor PLI actually gotten a lot of interest, and that showcases the fact that the next decade is going to belong to India. Can it take a couple of years from now to really materialize this? Yes, of course, right? By the time the capex goes into play, money comes in, all of that, there must be some few things to take care of, right? So I think this is a big thing that can actually drive markets in the future. National monetization program will take its own time. I don't think it's going to happen in a hurry. I think railways is the big chunk here. Railways will take some time to kind of get the act together. But this is something which I want to focus on. This is something which can typically make or break markets, inflation and interest rates. Now, if you circle back in terms of how China grew in the 80s and 90s, it is largely the double-digit growth with very low inflation and very low interest rates. Can India do that? I think India has to do that. Because once inflation goes up, RBI will feel very, very uncomfortable and start raising rates. And once cost of money goes up, not many entrepreneurs or promoters are going to, put money into the capex, because their return on investment goes for a toss, right? Very simple. So what is important here is the bond inclusion. This is one of the biggest legislation that we were hoping for, at least in this budget. And I'll tell you the reason, because the bond inclusion in the indices could have, over the next two or 3 years, gotten about $40-50 billion, which is so critical for India. And that would have helped to keep interest rates at a lower level. Let's hope that something happens in that direction. Now, this is something which I use typically to see the valuations in terms of the market, where the markets are. Now, it's a very simple chart, called the yield gap. And by the way, I'm one of the persons who believes that bond investors or bond fund managers do a better job of stock market. The reason being, they understand interest rates, right? Cost of capital. Money does not have emotions. Remember that, right? The moment an asset class becomes cheaper or more attractive, no matter what fundamentals you can give explanation, money is going to shift, right? So today is a time when you see there is a threat of interest rates going up, right? Now, typically what happens is this is a rule of thumb that the differential between the bond yields and the equity yields typically go from +3 to -3, right? By the way, for everybody's benefit, equity yield is just 1 by the P, 1 year forward P. And I've used Kotak's EPS estimates for this purpose. Today that gap is about 2 percentage points. So the bond yield is about 6.5%, equity yield is about 4.5%. So 1 divided by a P of 22 is about 4.5. Now typically markets change directions once that number crosses 2.5, 3, that's been the history, and this is through the world. So, if you take a very dispassionate view, and by the way, you can use this for your asset allocation. The moment market starts getting more expensive, the gap starts to increase. Unless earnings growth goes up meaningfully, that gap will continue to widen as markets keep going up. So as of now, what it appears is, the market either has to go up about 25% or so from here on for it to become really, really expensive, right? Or interest rates have to go up meaningfully for people to switch from equities to debt, right? So keep this in mind, and this is a fantastic way of estimating where your markets are, right? Because people just talk of PE in isolation, That's not the right thing, because you have to see where your interest rate cycle is in terms of determining. Because ultimately, market only understands the differential. Market does not understand absolute value, right? So somebody might say, 25 PE mein, markets usually top out. Maybe, but not always. Yeah. So I spoke about this, all these events could probably keep the markets a little dull and lackluster for the time being. Primarily because, like I said, it's fatigue. It's nothing to do with, anything. Like I said, events will keep happening, right? And by the way, I'm not underestimating the impact of this particular event. It can go to a full-blown war, but highly unlikely, right? Now think about it. We've crossed the 2003, 2004 crisis, the global meltdown in 2008. We survived the pandemic, right? I mean, masks are off, right? So, what else can go wrong? I mean, do you think anyone is ready for a war? Unlikely. Maybe it could prolong, the narrative could prolong because geopolitical situation is not getting any better. Everyone is trying to, including China, now Russia, they're trying to flex their muscles everywhere, right? So there will be a dramatic shift, probably, in the next decade in terms of, who's leading, who's getting the upper hand. And that's what we need to be careful about, right, as we move on. And like I said, rising rates globally also could impact flows into markets, right? Because typically, like I said, money does not have any emotions. So the moment US yield starts to rise, typically there is a sell-off in emerging markets, and the money flows back to the US and vice versa, and many other countries, right? So there's no rocket science behind all this. It's not that people have stopped disliking India. It's just that some other asset class is becoming better somewhere else in the world. So we need to be watchful of that. And the bottom price is actually the supply side bottlenecks and all of that is making life a little difficult for corporate India at this point in time, or even during the world. I mean, the semiconductor issue, all that will go away. So the point is that you have to use this volatility to essentially build your portfolio if you haven't already. So that's the bottom line, because we are investing from a long term. We are not traders here to really worry about events. And finally, these are some of the sectors where we think, our portfolios are kind of positioned. Like I mentioned, consumer discretionary, financials, industrials, real estate. And we are kind of underweight some of these areas. So that's it from my side. I have 40 seconds. Maybe I can take one question, Prem, or if anyone has got one. Yes, please.
Hi Ravi, Chinmay here.
Hi.
Very good morning to you.
Morning.
Ravi, about the yield gap that you mentioned, how do you see it 6 months down the line? Does US take some course correction that we gone wrong, increasing rates and things like that? Any sort of idea on that?
So if there is a war kind of situation, those yields may not go up.
Okay.
Right? So, a lot of it is event-led also. The Fed is not going to keep a blind eye in terms of, something that's happening, something serious that's happening somewhere in the world. So, a lot of factors will go in. Honestly, there's very difficult to kind of crystal ball into how these things are going to shape up, right? I think we should use whatever is available right now, position your portfolios accordingly, and then move on. Ultimately, equities is the best asset class. You can keep deciding in terms of timing, but honestly, nobody wins when they try to time markets. So it is important for us to be disciplined and remain invested, and use the concept to essentially increase or decrease your position. That's all. We are not talking about 1 or 0 here. We are going from say 80% to say 60% or 60% to 80%. That's the delta we are talking about, because ultimately equities will give you that 12 to 14% kind of annual return over the next 10 years. Yeah?
Any products that you would like to mention after the merger of two AMCs?
So, these are like babies, right? I don't have any specific preference, but certainly I think what's important is understanding the risk matrix of the investor. And, we are manufacturers, and so, we have a long list of products that'll be good for investors. So, from the large cap to hybrid funds, etc. So, no specific preference. If you're hinting at small mid cap versus large cap, etc. Honestly, that's not something which probably any of us should be looking at, because all these asset classes over a period of time, give similar returns.
Fine, Ravi. Thanks.
Right? Thanks so much. It was lovely again meeting all of you. Thank you.